Joining me now to explain is Dan Clifton, Head of Policy Research at Strategas. It's great to see you, Dan. And listen, everyone seems to be focusing on the fact that we're not going to default because we have the printing press. Well, that's not the point. We just had another debt ceiling show. I mean, at this point, of course we should expect that this could happen sometime in the future. It keeps coming up time and again.
That's right, Kelly. Let me start off by saying that 2011, investors took it very seriously. Turned out to be a one-time warning shot. People are extrapolating that and trying to compare it to today. We're in a very different environment today than we were in 2011. Then we had low inflation, low interest rates. We actually had significant savings out of the debt ceiling deal. And it was clear the U.S. debt to GDP trajectory was on much better footing. Today is very different. We're in a high interest rate, high inflation, or coming down inflation environment. And what that's doing is it's ballooning the interest cost of the debt. And so now we have a net interest cost that's rising for the first time in 35 years. And when the net interest cost goes up, it begins to squeeze out other domestic spending programs, and investors begin to get worried about what can actually start to get paid back. I get it. We got a pretty press with the reserve currency. We can get away with a lot more than other people had anticipated, that other countries can. But this is a very significant inflection point we're at. And as you know, Kelly, once you hit 14% of tax revenues for your interest costs, historically, the U.S. has moved into a period of austerity. We're right at that 14% today. Let me just tell you about Janet Yellen. Janet Yellen says when you get to about 3% of GDP in interest costs, you hit the danger zone. We're going to be there by the end of this year. So I tend to view this not as a political event, but as a warning shot that we need to get our fiscal house in order at these level of high interest rates. And if we don't, the Fed is probably going to have to come in here and help the Treasury out to be able to get those interest costs lower, because we are not on a sustainable pattern right now.
No, I've highlighted this before, that the public in 2011 was much more outraged about the debt and deficit situation, which is actually a lot worse today, but seems to be met with a shrug, even though interest rates are higher. What do you think the market is telling us? We saw bond yields jumping yesterday. It was a bit of a head scratcher. The economic data had been, mixed to weak. And yet everyone's starting to focus on the issuance that's coming, especially on the long end. And I'm not sure I'm always persuaded by issuance arguments. I feel like it kind of finds its home based on maybe nominal GDP or whatever. But maybe this time's different.
Yeah, I would argue just look at the gymnastics that Treasury is doing to raise the debt. There's always going to be buyers of Treasury debt. The question is what price you're going to pay. Well, the announcement that was made today is that Treasury is going to spend or they're going to issue another $800 billion of T-bills on top of the previous $1 trillion of T-bills at a 5.4% rate to finance the government operation.
Wow.
They can easily go out on a 10-year and do it at 3.5% rate. They're worried about the liquidity impact. They're worried about bank solvency issues. These are the first signs that there's stress building into the Treasury market. It's just not normal. Now, I'm not predicting an implosion. I'm not predicting that maybe, stocks should sell off because of this. But what I'm trying to say is what is happening is very reminiscent of what happens when your net interest cost begins to surge and there are problems bubbling underneath the surface. And so the Republicans are going to see this Fitch rating and they're going to say, oh, we want to hold up on that government funding for October 1st. And I think this raises the probability we're likely going to have a government shutdown on October 1st.
Oh, interesting.
And it's going to raise the pressure on the Fed to become more accommodative than they've been for the last 2 years.
You're absolutely right. It will act to kind of galvanize public attention on this issue, which maybe wasn't there 6 months ago. So most people look at this and go, okay, whatever the Fed does is going to kind of the yields will react. You're kind of making the argument from the other direction. When you look at the yields, you think the Fed might need to start cutting here to help Treasury out. Just explain that.
Yeah, well, I think we'll eventually get there. But clearly, yields have been moving in perfect proportion to the liquidity drain that we've seen since the debt ceiling. So as liquidity has come out, yields have gone up. That's exactly what we would expect. Same thing with the dollar strengthening, so to speak. What's going to happen is that there's going to be a forward look. And if you think about 2011, we raised the debt ceiling 12 years ago today. Today's the 12-year anniversary, which I think is an interesting data point. And what happened was it took maybe 6, 7, 8 weeks before the Fed began to really step in and they started Operation Twist. So that's down the path where you'll start to see it if these problems continue. But today's Treasury quarterly refunding announcement is saying we need more debt and that there's more strains on issuing that debt, that means we're going to have higher yields. That means the interest cost is going to continue to go higher on the federal government. And Congress is basically going to be passing budgets to pay interest. At some point, that's going to be financial markets pressuring austerity, and there's going to be political pressure to begin to change that. The Biden administration would love to wait to deal with this in 2025. Hopefully they can get through to 2025. But my sense here is that there's pressure is going to come a lot sooner than that.